It's all based on political promises, so there's a huge amount of anticipation that there could very well be a massive stimulus package by a Donald Trump government, both reflationary in nature and also potentially good for shares. But in the long run, are there downside risks to a Trump presidency? No matter how friendly, what do they pose to the market? This is the Moneymakers. I'm Bruce Whitfield, and tonight to discuss Trump trading, I'm joined via Skype by Chris Freund, who is portfolio manager at the Discovery Balanced Fund, to discuss where the smart money is going over the next 4 years as we go into the era of Trumponomics. Is that a thing, Chris Freund? Trumponomics, or is it Trumpnomics? What's the polite way of describing what Donald Trump is about to do to America and hence the world?
I think he's going to do something called anti-globalization. So for the last 20 odd years, the world has become more tighter-knit trading environment. And if he's to be believed, he's going to, put a America comes first flag in the ground and raise import tariffs, make it tougher to export into the US, and generally, try and get back the Rust Belt of Middle America and create some jobs there. So I think that's a lot more other things he's going to try and do in terms of stimulate growth, lower taxes, hopefully increase growth, increase the tax take, and as you said, potentially boost infrastructure. So the market's taken the view that most of this is going to be good in the short term, but you rightfully point out that over the long term there could be some pain involved with his policies.
Well, let's talk about the pain in just a minute. Let's talk about South Africa in the short term. We've seen a massive sell-off of global bonds. What was the number? $1 trillion worth of bonds around the world. Emerging market bonds in particular sold off, and that explained to a large degree the collapse in the peso and the very sharp fall we saw in the rand last week. We've been driven on the JSE certainly by currency fluctuations, because usually what happens is a rising United States takes the rest of the boats around the world and lifts their tide too. Why is it different this time around?
No, it's quite strange what's going on here, because normally, as you say, if perceptions of global growth improve, normally emerging market currencies would strengthen as opposed to the weaken which we've seen in the last week. Because emerging markets produce the commodities, which would then do better, the prices go up if global growth is going to strengthen. So this all makes sense. But recently we've seen growth perceptions improving, but EM currencies weakening. And it's essentially because the fear that, well, one of the big buyers of emerging market goods, being the US, is actually going to close its borders or make it tougher to export if you're an emerging market, export into the US. And hence you've seen the sort of the EM off trade, which is incredibly strange. I mean, it's the first time in many years where this has in fact happened.
But is it a knee-jerk reaction? We saw the early morning knee-jerk of the currency, market down 6 or 7% against the pound, as it became clear that Donald Trump was going to win the US presidential race against Hillary Clinton. And then there was that bit of a bounce and a recovery, and then a gradual deterioration in the value of emerging market currencies, and subsequently a little bit of a recovery once again. One gets the sense from outside of the markets that this is really just the uncertainty playing itself out, and markets trying to figure out what Trump really means.
No, I think that's right. I mean, I think one of two things has to happen going forward now. Either this is exactly as you say, a knee-jerk reaction to huge uncertainty, and the sort of traditional risk-off methodology is sell anything emerging market and buy the US dollar. So either this reverses itself in the not too distant future, and emerging market currencies in fact strengthen, or commodity prices have to fall, because commodity prices have got a big leg up in the last week, and because of Mr. Trump's supposed infrastructure plans, in addition to an already warming up China over the last 2 quarters or so. But you can't have it's really odd to have a situation where the commodity prices stay as high as they are at the moment, and yet emerging market currencies stay weak. You know, that gap is going to close one way or the other. It's either because, as I say, resource prices are going to come down, or emerging market currencies are going to go stronger. My own view, for what it's worth, is that I think that, in fact, emerging market currencies will be stronger in a quarter, 3 months' time or so, 3 to 6 months' time, and that the sort of improving growth pulse which we're seeing around the world will actually play out, and commodity prices will hold most of their gains which we've seen to date.
Now, the commodities you talk about, of course, are the industrial commodities like iron ore and copper, because we've seen the traditional sort of safe havens in times of crisis, commodities, maybe even platinum, but certainly gold. Gold lost $100 in 3 days last week. I mean, that sort of volatility is fairly unprecedented, certainly in recent times.
And I find the gold price difficult to decipher the best of times. But if you'd said to me Trump was going to win the election 2 weeks ago, I would have said gold will do very well in that environment. You know, a risk-off environment. The markets won't like a President Trump and all the uncertainty that comes with that, and hence gold would do well. The fact that it sold off is essentially meaning that the markets are already giving Trump the big benefit of the doubt. Don't worry about the uncertainty. Here comes growth. If here comes growth, then you don't need the protection that bullion gives you.
Now, when we throw caution to the wind, traditionally things tend to go a little bit pear-shaped at some point in the future. Markets certainly seem to be throwing caution to the wind right now.
Well, today it's coming back. Today, you know, there's been such a strong run in the last 4 or 5 trading days that today it's coming back in quite a big way. It's reversing the trends that we've seen, and that's entirely expected, and it just sort of has to happen. You can't have the iron ore price going up by 6% every day. It started to get, you know, hyperbolic. So it is coming back. Question of how far it comes back. The retailers are all up in a big way. The resource shares are all down in a big way today. How much longer does this go on for? It's probably going to retrace about half the gains in the last week. But again, my view is that I think that the commodity prices are set to stay higher than they were, let's say, 3 months ago, not as high as they were 2 days ago.
When we look at an issue of macroeconomics, though, if Donald Trump does get it right and he does impose many of these ideas that he's got, and the right of centre politicians in the United States certainly terribly excited, right of centre business leaders in the United States sees this as an early, is it Thanksgiving or would it be Christmas present? Probably Christmas by now present to markets in the United States.
Yeah, it's amazing. I mean, how the markets have taken it. Well, let's see what he does. You know, I personally think that when he gets in there, he's going to find it a whole lot more difficult to do a lot of the things he said he was going to, blindly said he was going to do. I think there are all sorts of checks and balances in place that will stop him from doing it. But generally, he will make some moves. He will make some anti-immigration moves, I think. Nothing like the sort of draconian, you know, wall and exporting 11 million immigrants, for example. But he will make some moves in the whole immigration area. He will make some tax move. He will make some tariff moves. Apparently, the US president has all sorts of authority to unilaterally decide a whole lot of tariffs. So he'll increase tariffs in the US. But, you know, what we haven't spoken about, Bruce, is the knock-on effect of this, what's now a trend. You could have said Brexit was a great surprise. But now, once we've seen the same populist or anti-establishment vote twice, I think there's a fair probability that we'll see it in Europe next year as well. And that'll bring a whole lot of new uncertainty to the market.
Now that's a big concern, of course, that's where France will go next. They've got a general election coming up toward the end of next year, I think. And Marine Le Pen, who is the leader of the National Front, is massively emboldened by the moves of the British with Brexit. And, of course, the appointment of Donald Trump as the 45th president of the United States. So in the United States, do we get another bubble developing as Europe then starts going through really difficult times and possibly a further dismantling of the European Union?
No, it's a good question whether we get a bubble. I mean, for most of this year, I've been quite cautious about equity markets because I've just thought the risk-reward trade-off is not good enough to take a lot of risk. Equity markets are not cheap. Maybe they're not that expensive, but it's hard to argue they're cheap. Growth was fairly pedestrian, and central banks have largely played their cards. Funny enough, right now, I'm less anxious than I have been for a long time. First of all, the growth delta has improved. If you look at in the US, if you look at China, and I would argue even that the European growth isn't going to be nearly as negatively impacted by Brexit as we thought it was going to be. So I think that, generally growth is improved, and central banks will, be quite cautious about hiking rates. So we've got more risk assets in our clients' pension funds now than we've had for most of this year. Whether it turns into a bubble, it's hard to say, Bruce.
Now, I mean, the fact that you're willing to take that risk implies that you see good times ahead for markets, because in a balanced fund you can mitigate the risks a lot more than you could in a general equity fund. So it's good to see that there's a nice opportunity there for markets. But will the South African economy be lifted by this rising US tide, do you think?
So higher resource prices will benefit the mining companies. The mining companies will theoretically be able to give bigger wage increases, employ more people or not fire people, etc. So there's a sort of very small positive benefit. I think that aside from that, we've got a few structural changes to make in this country. We seem to have locked ourselves into a fairly low structural trend growth rate, and we need to, as I say, make some structural changes to the economy. My own view, just throwing something else in here, is that we've got a Standard & Poor's debt decision quite soon.
But that's the point, isn't it? All of this global stuff is entirely theoretical until we know what's going to happen with our rating.
Well, what do you think is going to happen?
I'm hoping we get the pass, but I saw the finance minister this week and he's less confident now than he was before June. I'll just put it that way, which implies that even he's feeling a bit wary. And it's all about those structural reforms you talk about. It's about the state-owned enterprises,
right,
which remain distinctly untransformed and unchanged in a way that will appease the ratings agencies. Maybe they give us a break, maybe they don't.
I agree with you. I think we'll get a break. I think they will just pass on the decision again until June next year. I mean, some things have improved, Bruce. The external environment, as we were discussing, has improved. There's no doubt about that. The institutional fabric of this country has been tested in a very major way, and I would argue has not been found wanting. The judiciary have put up their hand and said no, many times. And so I think that it would be cruel and not wise for the S&P to downgrade SA debt at this stage, and they should just say give us a bit more time to achieve some of those reforms that we need to do.
Chris Freund, I'm going to get my producers to clip that and to send it to Conrad Royce at Standard & Poor's, and he can send it to the global network of the guys who decide on the ratings come December. Chris Freund, Portfolio Manager of the Discovery Balance Fund. More humps, bumps and trumps over the course of the next 4 years. Until next time, though, have a very good evening. Good night.